I think, uh, you know, I don't have to really talk about the recent crash, but it's something that was predicted or talked about for some time. But more fundamentally, I think very similar to the dot-com period, there has been a lot of speculative investments into AI-related companies, and more than 50% of the investments have gone into such companies. And then on the other hand, very similar to, because you bring up dot-com again, very similar to the dot-com investments that happened. A lot of them were not driven around value. They were a lot more speculative. There was no real ROI for a lot of companies. For example, at that time, it was driven by the number of subscribers or users for a particular application. There was no real business ROI. And in very similar terms, many companies that got investments, even in the AI world, has been driven around very similar speculative directions. So I think it's natural for some of those parameters to play in as we move forward. What you saw in the last week is probably around the same directions. But the markets have learned and have hugely probably understood a lot more from the previous crashes. So I think that's why it is not swinging so wildly, but it's also a real life scenario on how, even with all the topic that we are discussing, even with all the data analysis, even with everything that we have made progress around AI, we are still not able to avoid the crashes that are happening, right? So that's where all these topics that we have discussed today has a very significant impact, because with all of that, we still can't avoid the crashes. It will happen. And the human intuition, the human ability to bring in that context is even more important, and it's starkly visible as we go through this. So to me, in summary, I think, yeah, there is overinvestment. It's important to stay fundamentally close to the value. It's important to go back to the basics as we look at investments in AI and what companies should look at. So I would agree with your point.